Credit cards can be your best friend or your worst enemy. Used wisely, they can help you build your credit score, give you rewards like cashback or travel points, and even protect you against fraud. But when used poorly, they can trap you in debt that lasts for years, sometimes decades. And the scary part? Most people don't even realize the small mistakes they're making until it's too late. So today, I'll break down the 5 biggest credit card mistakes people make and exactly how you can avoid them. Stick around until the end, because I'll also share a bonus tip that could save you hundreds of dollars every year. This is the biggest trap, and it's designed to feel safe. It's the primary reason credit card companies make billions in profit annually. Here's how it works. Your bill shows a minimum payment and a total balance. Paying the minimum keeps your account in good standing, but it's a deceptive comfort as compound interest immediately piles up on whatever's left. Example: imagine you owe $1,000 with a 20% interest rate. If you only pay the minimum, say $25, it could take you over 5 years to pay it off, and you'd spend more than $500 just in interest. That's money completely wasted that could have been invested or saved. Always pay your full balance whenever you can. If that's not possible, pay more than the minimum. Even an extra $20 or $50 makes a huge difference. The faster you pay it down, the less interest you owe. We all love rewards: cashback, airline miles, shopping discounts. But if you're carrying a balance and paying high interest, those rewards are a distraction that actually costs you money. Example: you spend $1,000 and earn $20 in cashback. Sounds good, right? But if you don't pay off the balance and get charged $200 in interest, that reward actually cost you $180. You're literally paying for the privilege of a tiny discount. Focus on paying off your balance in full before you start chasing rewards. Only then do they become a true financial benefit. Remember, rewards are a bonus for responsible spending, not an excuse to overspend. It's tempting to apply for every shiny new card offering a huge sign-up bonus. But here's the catch. Every application triggers a hard inquiry on your credit report. This can temporarily ding your score by a few points and stays on your report for 2 years. Now imagine applying for 5 cards in just a few months. To a lender, this can look like you're desperate for credit, a major red flag that makes you seem like a risky borrower. The smart move is to apply strategically. Space your applications out by at least 6 months. Start with one great beginner-friendly card, build a solid payment history for 6 to 12 months, and then explore your next card. Building credit is a marathon, not a sprint. All right, mistake number 4. You've got that old credit card sitting in a drawer, collecting dust. Your first instinct might be to close the account. It seems logical, but this can actually backfire. Why? Because 2 influential factors in your score are directly affected. First, the length of your credit history. Lenders love seeing long-standing accounts, and closing your oldest one can shorten your average account age. Second, your total available credit. Closing a card reduces your overall credit limit, which can spike your credit utilization ratio. For example, if you have 2 cards with $1,000 limits each, you have $2,000 in available credit. A $500 balance means your utilization is a healthy 25%. But if you close one card, that same $500 balance suddenly puts you at 50%, a level lenders view unfavorably. So, unless the card has an annual fee you can't justify, keep it open. If it does have a fee, call your bank and ask to downgrade to a no-fee version. For any unused cards, just put a small recurring payment on it, like a streaming service, and set up autopay to keep it active. And now for mistake number 5, having a high credit utilization ratio. Credit utilization is one of the most misunderstood parts of credit scores. It's not just about paying your bill on time, it's the ratio of how much credit you're using compared to your total limit. This ratio is a key signal to lenders about how you manage debt. For example, if your limit is $1,000 and you spend $800, that's 80% utilization, which is far too high. Even if you pay it off, most issuers report your balance on the statement closing date, so that high balance can still be recorded, temporarily hurting your score. The golden rule is to keep utilization under 30% at all times. For an even better score, aim to stay under 10%. This simple habit shows lenders you're a low-risk borrower who manages credit responsibly. Here's a pro tip. If you're close to your limit, ask your bank for a credit limit increase. A higher limit instantly lowers your utilization. Another great strategy is to make a payment your statement closing date to lower the reported balance. And for our bonus tip, Always check your credit card statements for hidden fees and unauthorized charges. It's easy to overlook small amounts, like a $5, $10 recurring charge from a free trial you forgot about. Many people save hundreds every year just by reviewing their statements carefully. So let's recap. Don't only pay the minimum. Don't chase rewards while carrying debt. Don't apply for too many cards at once. Don't close old accounts unnecessarily. Always monitor your credit utilization. If you avoid these mistakes, credit cards stop being a trap and start being a tool, one that can help you build wealth, travel for free, and protect your money. Because at the end of the day, credit cards aren't dangerous. Misusing them is.